Chris Roberts here, and welcome to the Ultimate Guide to Investing in Multifamily Apartment Syndications, Module 2. The technical side of investing in real estate syndications. Your questions answered. Whether or not you have a background in real estate investing, commercial or residential, it's irrelevant. There are just a few things you need to know about syndications that are different than any other type of deal you've likely been involved in or had exposure to. Your grandpa owned a few properties. Cool. Your dad used to flip homes for profit? That's cool too. Now you're interested in approaching real estate a little differently. That's awesome. So it's natural to wonder about the returns, minimum investment requirements, taxes, and more when it comes to real estate syndications. Today we're going to address these 4 technical details. What are the returns like in a real estate syndication? What's the minimum amount I can invest? Can retirement funds be used to invest in syndications? What about taxes? We love details too, and commend you for digging into not-so-surface elements of this type of investment. Number 1, returns. As with most investment vehicles, people are attracted by and curious about the possible returns. By investing passively in a real estate syndication, you can earn 2 types of returns: cash flow and profit splits. Cash flow returns are checks or directly deposited, typically on a monthly basis from the time the deal closes until the asset is sold. Profit splits are where the investor literally splits the profit from the sale of the asset according to the structure outlined in the contract. Here's a great example using round numbers for ease. Let's pretend you invest $100,000. You can look forward to a possible 8 to 10% return of cash flow, meaning $8,000 a year, which is about $667 per month. Additionally, when the asset is sold 5 years later-ish, you could expect up to 40 to 60% returns on your initial capital investment. This means you receive your $100K back on the initial investment plus maybe $50K in profits. Adding it all up in your head? Seeing the dollars? Yep, pretty cool. 8,000 cash flow returns per year plus $50K in profit at the sale means you would have turned $100K into $200K in just about 5 years. Now this, of course, all comes with a caveat that these are estimated returns and can vary based on market conditions, location, the deal structure, and many more variables. In no way is this a guarantee that you'll double your money. We're just saying that it's seriously possible though. Number 2. Minimum investment amount. The typical minimum threshold for investing passively in real estate syndications is $50,000. Anyone interested in investing at this level should have liquid funds beyond this investment value. Should be aware of the potential losses and be okay with the possibility of losing these invested funds. Your money will be illiquid during the hold time, and you can't withdraw your investment capital until the asset is sold. Thus, you should intentionally set up financial arrangements so that you will not need the access to this money for quite some time. Number 3, retirement funds, nay or yay. Retirement funds can be used to invest passively in real estate syndications. Yeah. In fact, this is how many investors get their feet wet with syndications. To invest in real estate syndications with retirement funds, you must first roll your existing account, 401k, IRA, etc., into a self-directed IRA or EQRP account. There are many self-directed IRA companies out there who would be happy to help you with this. Once your funds are in a self-directed IRA account, you can choose what you want to invest in. You'll need to coordinate with your self-directed IRA custodian, provide them the copies of your legal documents for the syndications, and they will send the funds on your behalf. The only requirement for this situation is that all returns must go directly back into the self-directed IRA and never into your personal accounts. Number 4, tax benefits. You don't get to do anything these days with your money without some sort of tax implication. Investing in real estate syndications is no different. As a passive investor, you are part owner in an underlying asset, which means you get a share of the tax benefits. One of the largest ones is accelerated depreciation through cost segregation. Owning rental properties comes with the ability to depreciate the value over time. With commercial real estate syndications, the sponsor often orders a cost segregation study, where an expert will provide a report delegating assets eligible for accelerated depreciation. All big words aside, this means that you get the benefit of front-loading depreciation into the first few years of ownership instead of over a 30-year period. Perfect for a 5-year deal. Confident in the technical details? Now that some of your specific questions about the technical side of passive investing in real estate syndications have been answered, you can approach your search for a deal confidently. You now know that retirement funds can be used, that the minimum investment is only $50,000, that there's potential for serious tax benefits and returns. And sure, there are risks, like with anything, but now you have a clear picture of what your next steps are. If you were considering investing with retirement funds, you know to begin seeking help in rolling your funds into a self-directed IRA. If you weren't sure if you had enough liquid cash to invest, now you know what the minimums are. If you didn't understand why people said you could double your money in just a few years, your eyes have been opened. With less technical questions floating around in your mind, you're that much closer to becoming a confident passive real estate syndicator investor.